Hi, I'm Sharmila and welcome to my channel BD Business World, where people like you and me will have a walkthrough of business concepts in less than 5 minutes. I'll be covering different topics from areas of finance, operations, marketing management, economics, statistics, business analytics, project management, and many more related to business. As this is my first video, I'll be starting with the ABCs of business, that is alpha, beta, and kappa. Today we'll go over what is alpha, where it is used, and how it is calculated. Have you ever heard of this term with respect to investment, be it a stock you are buying or any other form of investment you are doing? Alpha measures the performance of an investment relative to a benchmark index, accounting for the level of risk taken. Here, there are two things that we need to consider. The performance is calculated relative to the benchmark index, considering the level of risk for the investment. Benchmark index is nothing but market index in majority of cases that is used as a reference point to compare to portfolio performance. For example, S&P 500 index. So this alpha measures indicates whether an asset has outperformed or underperformed the market after adjusting for risk. That is, whether it has delivered returns above or below the expected CAPM-based model. It's a backward-looking measure, that is, it is a historical value of how the investment has performed so far, but it can also have forward-looking interpretations. Now, why do we look at alpha? So basically, it gives us the historical performance of portfolio, which can be used to compare different investments. Based on alpha values over the long period of time, we can evaluate if specific strategies of portfolio balance are more beneficial over others and adjust accordingly to optimize the portfolio. It can also help indicate if the manager is skillfully managing the portfolio or not. For example, if the portfolio has consistent positive value, irrespective of the bullish or bearish market movements, that means the manager is really skillful. Versus if the performance is not stable and it is dependent on rally in a specific sector or news, or performance is achieved by taking too much risk, then those things are for concern if you prefer stability over risk. Let's see how is alpha calculated. Here is the formula for alpha. Alpha is equal to the actual return of the investment minus the expected return. So here R of I indicates the actual return and expected return is nothing but RF plus beta into difference between the market return minus the risk-free return. Now, the risk-free rate of return is nothing but a 10-year treasury yield. So let's see how this works. As I mentioned, RF is the risk-free rate of return and it is the rate of return on investment where risk is zero. So theoretically, there is always some risk associated, but US Treasury bills are considered risk-free as it is backed by government. So in this formula, we can consider RF to be the rate of return for US Treasury bill, usually the 10-year Treasury yield rate that is used. RM is the market return, which is nothing but return on benchmark index. So we'll be considering S&P 500 index return as benchmark return. And beta is the systematic risk of the investment or how volatile the investment is. Beta itself is the next big topic and we will go over the details of beta in next video. So now let's focus on alpha. After including the values of these parameters in the formula, we get the value of alpha. If the value of alpha is greater than 0, that is positive alpha, it indicates that investment has outperformed the market. If the value of alpha is less than 0, that is negative alpha, it indicates that the investment has underperformed the market. Whereas alpha equal to 0 indicates that investment has performed in line with the market. That is, it has given its expected return considering the risk levels. Let's find the alpha value for the stock Nvidia. Now here we are considering the time period of 1 year ending January 9th, 2025. The actual return of NVIDIA, how do we calculate it? We get the stock price of NVIDIA on January 9, 2024, which is $54.34, and NVIDIA stock price on January 9th, 2025, which was $140.11. Now the actual return is the current stock price minus previous stock price divided by previous stock price, which is nothing but 157.9%. Here the risk-free rate is the 10-year treasury yield as of January 8, 2025, which is 4.67%. Now you can get this value from YCharts website. You can also find the beta of NVIDIA. That information you can get it from maybe Yahoo Finance or any other website, financial website that gives you information about stock. So the beta of NVIDIA is 1.66. The market return here is nothing but the return of S&P 500 for the same period, which is 23.81%. This value you can also get it from Yahoo Finance. Now, once you put these values into the formula, you will get the alpha for NVIDIA, which comes out to be 121.47%, which is a huge value, and it indicates that NVIDIA has outperformed the market by very large. So usually the alphas are reported for mutual funds or portfolios or set of like stocks that come in the form of a portfolio. So if you go to the Yahoo Finance and try to look for alpha for NVIDIA or any other individual stock, you may not get this value available. But if you look for alpha for certain funds, then you can definitely get it there. Here is an example for alpha for funds, and the fund that I've used here is Fidelity Magellan. So like I mentioned before, alphas are reported mainly for funds and not individual stocks, and the reason is stock returns are absolute. It shows price change over time, and alpha is used to measure the excess return over a benchmark. And when it comes to benchmark, it is usually a collection of stocks that follows certain conditions. For example, S&P 500 index. It is a collection of 500 largest publicly traded companies. Dow Jones Industrial Average E. So it's a 30 large blue chip US companies. In such cases, we cannot really compare return of a given stock against the performance of group, but we can compare performance of group against group. So if you go to a Yahoo Finance and search for the sticker of mutual fund, you can definitely see the alpha reported. And in this case, you can see that the alpha reported is negative 2.08. That means this fund is doing this fund is underperforming as compared to the market. So to summarize what we have learned about alpha, it is an excessive return against benchmark considering the risk. It's a historical measure. It's measured in percentage and mainly used to find out how managers are performing for actively managed portfolios and identifying strategies for portfolio optimization over the period of time. So thank you for watching this video. If you would like to watch more of such interesting topics from business, please like, share and subscribe to the channel. Hit me in the comment about what topic you would like to know next, and for that comment me in the chat below. See you all soon in the next video and conquer the world. Thank you.